Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. It was around mid-July that I released a podcast called The Great TFSA Rotation here on Supernatural Stocks. Now, it was by far the most popular Supernatural Stocks podcast on Moneyweb thus far, which tells me that people are really interested in making the most of their tax-free savings accounts or TFSAs. This makes me very happy because honestly, these accounts are a life hack of note. Every South African who has equity exposure should have one of these accounts and in my opinion, should be maximizing them every single year. After all, why choose to pay tax when there is a perfectly legal, government-encouraged way not to? Now, the downside to those accounts is that your choices are limited in terms of what you can invest in. But downside is a relative term here. Sure, the government is not going to sponsor you to have a punt at ArcelorMittal, and well done to those of you who did. It seems to have worked out. But they will give you a hand in buying ETF exposure. I believe that any equity portfolio should be using ETFs or exchange-traded funds to achieve market exposure. So that's not really a problem. You can just dabble in single stocks outside of a TFSA environment. And while we are on that topic, just remember that single stocks need to be a particularly good opportunity to justify their inclusion in a portfolio. Otherwise, just go and buy the ETF. These single stocks need to be able to beat the index and by quite some margin to make up for the risk of taking single stock exposure. Now, over time, a few hundred basis points a year of outperformance does make a massive difference. Just ask Warren Buffett, who is world famous for beating the index by an amount that doesn't really sound like a lot on paper, and yet the magic of compounding turns it into the difference that makes him the ultimate rock star investor. Now, the pursuit of rock stardom is great, but it is probably not going to happen in your TFSA. Or will it? Well, as I discussed in July, you are allowed to rotate your ETF exposures, provided your TFSA sits with a broker who offers all those products. You're not withdrawing from your TFSA in that case, you are simply reallocating the money, and that is a very, very large technical difference. You can't go and withdraw from your TFSA and just go plug it into another one in the same year. That doesn't work. If you rotate really, really well, you can actually beat the index without ever even owning a single stock directly. And I think that realization is what made that podcast episode in July so popular. But of course, this is a great opportunity to now look back a few months and see if my plan worked. If it did, great. If not, it's something to learn from. Back in July, I felt like the OneInvest S&P 500 Infotech Feeder ETF, a real mouthful, had simply run too hard. I had done incredibly well on that ETF because it is heavily weighted towards the likes of Microsoft, Apple, and Nvidia. It was a big decision to walk away from that exposure, but I felt that it was time, for now at least. The podcast was released on 15th July, with the ETF trading at 30 Rand 15 cents. Roughly 3 months later, that ETF is now trading at around 28 Rand 40 at the time of recording, a dip of approximately 5%, and it's actually been a lot worse because in the past few months it even traded below 26 Rand, so that is quite the correction. As it transpires, Rand strength has actually been one of the reasons why that thing has come off. Of course, with hindsight, I do wish that I'd bought back in at those levels below 26 Rand because I would have made a nice upswing profit now. But there is a big difference between rotating from time to time and just churning yourself to death. Apart from the very low likelihood of getting the timing perfect, there are transaction costs that you need to consider. You are paying brokerage even if you are not paying tax. Also, what is your time worth to you? What is the cost of watching the market permanently, basically, instead of making more money in your business or working harder in your career or spending time with your family, the best option of all? A practical approach is the right one here, so just try to balance off rotation and churn. And as we look at what I rotated into, we can actually see here that I shouldn't feel too bad about not buying back in below 26 Rand. The churn hasn't been necessary because the thesis I had around where my money has gone has played out really, really nicely. Using the Satrix Property ETF as an easy example, it traded at 10 Rand 64 on the 15th of July. Now it's at 11 Rand 62. That is growth of around 9% in roughly 3 months. If I'd stayed where I was in that US tech-focused ETF, I would be down 5%, not up 9%. That is solid outperformance. I'm obviously really thrilled with it. And that's not even taking into account the dividend yield, which is much higher on property stocks than it is on tech stocks. So let's recap my thesis of why I thought property would do well this year. In fact, coming into this year, I thought property may well be the best sector on the JSE in 2024. Why is that? Well, simply because interest rates had to start falling at some point, and the property sector is the ultimate winner in that situation. There are two very good reasons for this. The first one is that property funds are heavily indebted animals, as they use loads of leverage to drive decent return on equity. Just think about the way in which you buy a house using a mortgage or a bond. The deposit on the house is sometimes zero. In listed property fund land, it's nowhere near that extreme. They are generally funding 60% of their assets with equity and the rest with debt. But as rates drop, that debt gets cheaper, and so there's more money left for shareholders. The second good reason why property should have done well this year is that lower interest rates lead to fewer other opportunities to go and get higher yields. This means that investors are willing to accept a lower yield from the property funds because their opportunity set overall has diminished. If the dividend coming out of a property fund stays equal, this means that the share price goes up because investors drive that price higher by chasing that yield. But in reality, those two reasons actually work together, because not only are the underlying earnings better as the cost of debt comes down, but investors are willing to pay more for those earnings over time as interest rates come down. And to add to this beautiful spinning flywheel, the underlying property values are also higher, which means funds can refinance properties and unlock capital to go and invest in new opportunities. This expansionary behavior drives the next leg in the cycle, eventually culminating in a property market that is simply too hot. And guess what? At that point, it's time to rotate out again. But I don't believe we've reached that point yet. Now, if only my Mr. Price short thesis a few weeks ago had worked this well. But unfortunately, you can't get them all right. Nobody can. But I'm very, very happy with how well this rotation has worked, certainly for now. Situation can change, of course. I might live to regret it. But right now, 3 months in, I'm personally very happy. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.